Imagine walking into like this massive, heavily fortified bank vault, right? Stacks of cash just piled floor to ceiling.
Oh, yeah, the classic Hollywood image.
Exactly. Millions, maybe even billions of dollars just sitting there in the dark.
Yeah.
And it's waiting to be deployed into the economy to build hospitals or, fund exciting new startups, expand local manufacturing plans. But there is a catch.
There's always a catch.
Right. The heavy steel door to the vault is completely locked. And the only way to get the money out to the people who need it is through this tiny, like 6-inch window.
Wow.
And managing that window.
Ray.
3 totally exhausted people just chugging cold coffee, processing paperwork by hand, literally one sheet at a time.
That's a pretty grim picture, but incredibly accurate.
Yeah, and before we unlock exactly what is happening in that vault today, I want to quickly mention that this deep dive is brought to you by AI Opportune.
I love them.
Right, because to understand massive technological shifts like the one we're unpacking today, you really need a reliable guide. If you want to stay ahead of the curve and genuinely understand the AI trends shaping our world, you need to subscribe to AI Opportune.
Yeah, I couldn't agree more. The space is moving so quickly right now. You really need that kind of curation to separate the actual signal from the noise.
Definitely. They are delivering some of the absolute best AI insights out there right now, so highly recommend you go hit subscribe on their feed. But anyway, speaking of noise, welcome to the deep dive. Our mission today is to explore a really fascinating stack of 2026 market data we've gathered, alongside a super revealing case study on a Boston-based fintech company called EnFi.
Which is doing some incredible things, by the way.
Totally. We are looking at a massive structural shift in the financial world. We're talking about how artificial intelligence is actively transitioning from being, just a helpful little co-pilot on your desktop into a fully autonomous, self-directed digital workforce.
And I want to emphasize right up front, while our sources today do focus heavily on the commercial banking sector, this isn't just a finance story.
Right. It's bigger than that.
Much bigger. For anyone listening, no matter what field you're in, this is a preview. This is a very clear window into how knowledge work across all industries is fundamentally changing in real time. Basically, if you work at a computer, this affects you.
Right, because there's this profound irony in the current banking landscape that really caught my eye in the reading. When you think about a bank's growth being limited, you usually assume they've just, run out of money to lend.
Yeah, that the vault is empty.
Exactly. But that's not the case today. The growth isn't limited by capital. It's limited by what our sources explicitly call a human wall. Banks have the money. They genuinely want to lend the money. But they physically cannot process the loan applications fast enough.
Because the traditional credit decisioning process is just inherently manual, and it's incredibly high friction. The capital is there, sitting completely idle, but the capacity to distribute it is artificially choked by the speed of human data processing.
Okay, let's unpack this. It's like having a massive reservoir of fresh water, but you're trying to hydrate an entire city through a single kinked garden hose.
That's a great way to put it.
Why exactly can't a bank just approve a loan if they have the cash on hand? Like, what is actually happening in the back office that takes so much time? I mean, I remember applying for a small business loan a few years ago, and I swear I waited 3 weeks just to find out they had lost page 4 of my tax return PDF.
Oh, man.
The friction is maddening.
Well, that exact experience you had is happening at scale every single day. Let's look at the mechanics of what a human credit analyst actually has to do for every single commercial loan. It usually falls into 3 buckets.
Okay.
First, you have manual data spreading. And spreading is just an industry term for extracting financial data from a mountain of disparate sources.
So, like, messy documents.
Oh, incredibly messy. We are talking scanned PDFs, hundreds of pages of tax returns, bank feeds, sometimes even handwritten notes. And they have to organize all of that chaos into a standardized financial model. It is super tedious, eye-straining work. It requires intense focus, and let's be honest, human beings are naturally terrible at maintaining that kind of focus for 8 hours straight.
Oh, I can only imagine. The psychological toll of staring at spreadsheets trying to pull line items from a scanned PDF of a 5-year-old tax return where the ink is smudged.
Exactly, and that's just step 1. Then comes the second step, which is risk evaluation. The analyst has to assess the borrower's leverage, their liquidity, and their overall financial health against these highly rigid, complex internal bank policies.
Right, checking all the boxes.
Right. Does this loan violate Section 4, Paragraph B of the bank's lending charter? You have to check manually. Finally, there is collateral review, verifying the assets the borrower is pledging, checking public UCC filings, matching inventory lists against accounts receivable.
Just hunting for inconsistencies, basically.
Exactly.
It's essentially forensic detective work mixed with high-stakes, mind-numbing data entry.
It really is. And here is a staggering statistic from the 2026 market data we're looking at. 27% of community bank leaders now identify AI as their top priority.
Wait, 27%? In banking? I would have assumed cybersecurity would permanently hold the #1 spot. I mean, you're constantly fending off hackers.
You would think so, yeah. But AI has actually surpassed cybersecurity for these leaders. And the reason isn't because AI is shiny and new. It's purely about operational survival.
Because of the human wall.
Yes. There are currently thousands of credit analyst roles sitting completely unfilled across the country. Banks are realizing they simply cannot hire their way out of this backlog.
Wow.
The talent pool just isn't there, younger workers don't want to do manual data entry, and the sheer volume of data generated by businesses is too high. What's fascinating here is the bottleneck for commercial lending has entirely shifted from the balance sheet to the back office.
So the constraint isn't dollars anymore.
Exactly, it's data processing.
That completely flips how I think about a bank. You always picture the constraint being the size of the vault, not the size of the desk. So if human headcount is a fixed ceiling, the only way to scale the business is to decouple loan volume from human hours.
Bingo!
But if they can't solve this problem with human hires, because the humans literally aren't there to hire, who's actually solving this? Because building a banking-grade AI isn't something you just, code up over the weekend in your garage.
No, absolutely not. It requires immense capital and really deep vertical expertise. Which brings us to the big market pivot.
Here's where it gets really interesting. Because our sources highlight EnFi, that Boston-based fintech company. They just secured a $15 million Series A funding round, which brings their total capital to $22.5 million.
Which is a huge signal.
Right. And for anyone listening who is outside the startup bubble, a Series A basically means they've moved past the experimental seed stage. They have a product that actually works in the real world. They have proven market fit. And now investors are injecting serious capital to aggressively scale it.
And the key distinction here is what EnFi is actually building. They aren't building a productivity tool.
Right. It's not a fancy spell checker.
Exactly. They aren't building a better calculator. They are deploying autonomous AI agents directly into banking operations.
Wow.
To really grasp the magnitude of this shift, we have to look at the timeline of the last couple of years. If you recall, 2024 was widely considered the year of the AI assistant.
Yeah, the copilots.
Right. You had tools helping you write a polite email or summarizing a Zoom meeting for you. They waited for you to give them a prompt. But 2026 is officially the year of the agentic workforce. These agents don't wait for a prompt. They run in the background, executing multi-step workflows. The AI agent market is projected to hit $12.06 billion this year alone.
$12 billion. That is massive.
And it's growing at an explosive compound annual growth rate, or CAGR, of 45.5%.
Which basically means the financial footprint of this market is practically doubling every 2 years.
Right. That kind of growth trajectory only happens when a technology moves from being a nice-to-have convenience to being a mandatory core operational engine.
Okay, so let's talk about the mechanics here. What do these autonomous decision engineers actually do? Because as our sources emphasize, they don't just help the human analyst. They do the core tasks themselves.
Yes, they take over the process entirely.
But how? Like, how does a machine read a messy, smudged PDF of a tax return without completely making things up?
That is the big technological breakthrough. Historically, banks tried to use template-based OCR optical character recognition. But if a line item on a tax return shifted down by even half an inch, the old software would just break and spit out gibberish.
Oh, I've used that software. It's so frustrating.
It's the worst. Today, though, companies like EnFi are combining next-generation OCR with localized large language models that have actual semantic understanding.
So it's not just matching pixels.
Right. The AI doesn't just look for where text is on a page. It understands what the text means.
So it knows the difference between gross revenue and net income, even if the accountant who uploaded the file used some weird non-standard abbreviation.
Exactly. Let's break down those 3 manual steps we talked about earlier, but now through the lens of this agentic workforce. First, application ingestion.
Okay.
The AI agent instantly ingests the unstructured financial data. It reads the tax returns, the bank feeds, understands the context, and standardizes it perfectly into the bank's model in literally seconds.
Which eliminates the very human error of typing an extra zero in the wrong column at 4 p.m. on a Friday, which, I mean, could theoretically ruin a multi-million-dollar loan.
Precisely. The second task is policy alignment. The agent automatically cross-references all that standardized data against the bank's specific localized credit policy.
Okay, so it memorizes the rule book.
Yes. It knows exactly what the bank's risk appetite is, and it instantly flags any deviations. And then the third step, and this is where it truly steps into the realm of complex knowledge work, it actually drafts the initial credit memo.
That is the part that completely blows my mind. Because, for context for the listener, a credit memo isn't just a sticky note.
No, not at all.
It's often a 15 to 20-page, highly structured narrative document. It synthesizes the data, explains the policy flags, and makes a coherent argument that a loan committee will eventually review. And the AI is writing this from scratch.
Yes. It drafts the entire qualitative and quantitative argument for or against the loan based on the data.
Okay, wait, hold on. I need to play devil's advocate here.
Sure, go for it.
Because if I'm a listener, especially if I run a business or have my life savings in a bank, I might be feeling a little uneasy right now. Are we really at the point where we trust an AI with million-dollar financial workflows instead of a human?
It's a very fair concern.
Like, if an AI misreads a zero or hallucinates a phantom asset and autonomously approves a bad $4 million loan, who gets fired? The AI. You can't fire code. How are banks legally protecting themselves here? We are talking about the lifeblood of the economy.
That is the exact right question to ask, and honestly, it's why the deployment of this technology is so heavily scrutinized by regulators. The short answer is, the bank's executive team, specifically the chief risk officer, is ultimately responsible.
Right. Someone has to take the fall.
Exactly. But the sources are very clear on how this risk is mitigated through governance. These agents are what we call vertical specific. They aren't generic large language models pulling random information from the open internet like the chatbots most consumers use.
Oh, I see. So they don't know how to write a poem or give you a recipe for banana bread. They only know commercial credit.
Exactly. They are trained exclusively on banking-grade data, and more importantly, they operate using what engineers call deterministic guardrails.
Deterministic guardrails, what does that mean in practice?
Well, generative AI is naturally probabilistic. It basically guesses the next best word, which is why it sometimes hallucinates. But these banking agents are hard-coded with deterministic rules. They are not allowed to improvise policy.
Oh, so they can't go rogue?
Right. They execute complex logic, but if a parameter falls outside a strictly defined confidence interval, the agent just stops and routes it to a human. They are executing rules-based logic with zero fatigue.
Okay, so it's a closed system, it's heavily regulated, and it knows when to raise its hand and ask a human for help.
Exactly.
But I'm still trying to wrap my head around the daily operational reality of what this does to a bank's bottom line.
If we connect this to the bigger picture, the operational gains are what we might call an absolute earthquake in the industry. Let's look at the metrics. We are moving from a human-only workflow where decision speed took days or sometimes weeks.
Yeah, like my 3-week wait.
Right, to an AI agent-integrated workflow where decisions are made in minutes or hours.
Days or weeks down to minutes or hours. That is an absolute paradigm shift for a local business owner who is waiting on funding to make payroll or buy new equipment.
It's huge.
Waiting 3 weeks for capital can literally kill a small business.
It absolutely can. And beyond speed, data ingestion moves from being manual and error-prone to automated with near-perfect accuracy. But the biggest shift of all is throughput.
How many loans they can process.
Yes. In the old model, your loan processing volume was strictly capped by your headcount. If your 5 analysts can only review 10 loans a week, your bank only issues 10 loans a week, no matter how much money is sitting in the vault.
But with AI agents, throughput is scalable with demand. Because if 50 businesses apply on a Tuesday, you just automatically spin up more server space to handle the agents. You don't have to hire and train 5 new humans.
Exactly. By automating the gray areas of data spreading, which the 2026 data suggests is a task now considered virtually extinct for standard commercial loans, banks are seeing a massive change. Our sources point to a 75% autonomous resolution rate for routine credit conversations.
Wait, let me make sure I heard that right. 75% of routine standard loans are being essentially resolved autonomously.
Yes. For standard loans, The AI handles the journey from ingestion to memo drafting to preliminary decisioning, with the human acting only as a final reviewer before the funds are wired.
Wow.
And this automation is the great equalizer. It allows traditional, heavily regulated, 100-year-old community banks to compete with the lightning-fast speeds of modern fintech startups.
Right, but without sacrificing the institutional rigor and compliance that keeps the banking system stable.
Exactly.
So what does this all mean? We really have to address the elephant in the room here. If an AI agent can ingest the messy tax returns, align it with complex banking policy, draft the 20-page credit memo, and resolve 75% of routine loans, what happens to the human analysts? Are we looking at a mass extinction event for back-office finance jobs?
It is the most logical fear people have when they hear these numbers, but the 2026 consensus across all our sources is a firm no. Human analysts are not completely out of a job.
Oh, really?
Yeah, what we are seeing instead is a rapid evolution. The role of the human credit analyst is evolving into what the industry is calling a risk architect.
Risk architect. I mean, I like the sound of that.
Yeah.
It sounds much more strategic than data spreader.
It definitely is.
But I also have to imagine that transition is messy.
Yeah.
It sounds great on paper, but if you've spent the last 10 years getting really, really fast at Excel, and suddenly your boss tells you to go judge a CEO's character because the AI is doing the spreadsheets now,
Yeah.
that is going to be a terrifying pivot for a lot of people.
Oh, it is a massive psychological shift. The skill sets are completely different. Look at how the loan volume is being split now. The AI agents are handling the standard loan volume, typically in the $1 million to $5 million range.
The easy stuff, relatively speaking.
Right. These are loans where the parameters are well understood, historically rich, and purely rule-based. Because the AI is handling the routine work, the human analysts are being forced to move up market.
They're being freed up from holding the garden hose
Right.
so they can actually go architect a better reservoir.
This raises an important question. How exactly does human value change when the machine takes over the logic? According to our deep dive sources, human analysts, these new risk architects, will now have to focus their time on 3 highly complex, deeply human areas that machines struggle with.
Right. Let's go through these 3 areas because I feel like this is the blueprint for the future of work. The first one the sources highlight is complex deal structuring. So we're talking about massive M&A finance mergers and acquisitions and bespoke collateral packages.
Exactly. When you are financing the merger of 2 massive multinational companies, or you are dealing with highly unusual collateral, say, intellectual property or a fleet of custom-built shipping vessels, that just doesn't fit neatly into a standardized spreadsheet.
Right. An AI would just throw an error code.
Yeah, you need intense human creativity and negotiation. You need an architect to structure a deal that mitigates risk but still works for both the bank and the client. A machine can follow rules to perfection, but a human can invent a completely new structure that satisfies a complex, unprecedented need.
That makes total sense. You can't write a rule for something that has literally never happened before. Which leads perfectly into the second area for the risk architect qualitative assessment, evaluating management integrity and unquantifiable black swan risks.
This is crucial, and it's something an AI fundamentally cannot do because AI relies entirely on historical training data.
Right. It only knows the past.
Exactly. An AI can look at 5 years of perfect tax returns and say approve. But a human analyst can sit across the boardroom table from a CEO, look them in the eye, ask them tough questions, and realize, I don't trust this person's integrity.
Yeah, the vibes are off.
Exactly. Or a human can look at the current geopolitical landscape and foresee a black swan event, an unprecedented, highly improbable crisis, like a sudden trade embargo on a specific raw material the borrower relies on. The AI has absolutely no historical data to predict that embargo.
So human intuition, contextual awareness, and character judgment become premium skills.
Yeah.
You just can't code a gut feeling about a founder's character. And the third area where human analysts will focus is relationship management. Actively coaching borrowers on how to improve their key performance indicators or KPIs to secure better terms in the future.
This is where banking really returns to its roots. Instead of the analyst being locked in a windowless back room crunching numbers, they are out in the field.
Like a real partner to the business.
Exactly. Imagine a local manufacturing plant that is struggling with cash flow. The human analyst goes to the plant, sits down with the business owner, and acts almost like a financial consultant. They say, look, our AI agent flagged your leverage ratio as too high, But here's how we can work together over the next 6 months to improve that specific KPI, restructure your debt, and get you a better interest rate.
Wow, so it's highly empathetic advisory work,
Yes, it's building trust.
which is incredible. It really paints a picture of a future where humans are finally allowed to do what humans actually do best, connecting, judging character, strategizing, and empathizing, while the machines do the heavy lifting of data processing.
It's a huge shift in how we value labor.
It really is. So let's distill everything we've uncovered in this deep dive. The massive $15 million funding round for EnFi isn't just a win for one Boston startup. It is a blaring market signal. We are witnessing a strategic shift from companies simply buying AI software as a neat little tool to investing in massive AI workforce infrastructure.
The paradigm has fundamentally shifted from software you use to software that works alongside you.
Exactly. The most successful startups in 2026 are the ones replacing entire workflows from start to finish, not just optimizing individual disjointed tasks. The bottom line takeaway from our sources today: speed is the new competitive moat.
100%.
If you are a financial institution, AI agents are no longer optional. They are the baseline requirement just to maintain your economic capacity. And for you listening, I want you to really think about your own daily workflow, no matter what industry you are in. It doesn't have to be finance.
Oh, absolutely.
How much of your day is spent on the equivalent of data spreading? Are you pulling numbers from one system just to manually type them into another? Are you summarizing reports that someone else summarized? Because if an AI agent can do that, the real question is, how can you shift your focus today? How can you start positioning yourself to become the risk architect in your own career before the transition becomes mandatory?
I think that is the perfect lens to view all of this through. It is all about personal adaptation. And I'll leave you with this final thought to mull over as you go about your day. For decades, we have valued employees based heavily on their ability to act like machines, to reliably, flawlessly execute standardized, rules-based logic without making errors.
Right, being a perfect cog in the machine.
Exactly. But if autonomous AI agents are now taking over all of that logic, does that actually make deeply human, completely unprogrammable traits, like trusting a founder's character, showing genuine empathy to a struggling client, or navigating an unprecedented black swan event, the most valuable and expensive skills on Earth?
Oh, that completely flips the script on what it means to be valuable in the workforce. We spent the last century trying to be machines, and now the machines are going to force us to be more human. Such a fascinating shift. Thank you all for joining us on this deep dive. Keep examining your workflows, keep anticipating the shifts in your industry, and most importantly, keep questioning the world around you. We'll catch you on the next one.